earn in India, invest abroad. What does this wealth strategy of the rich tell us? Imagine an Indian businessman sitting in his Mumbai or Delhi office in the morning. His business is running in India, his customers are Indian, his factories are in India, and his ports, mines, digital services or consumer markets are all tied to India. His income is built on India's growth. But in the evening, when he looks at his wealth planning, his investment accounts start turning towards Singapore, Dubai, London, or some other global financial hub. His children are studying abroad, a family office is being set up outside, and a retirement plan is being made far from India. The fear starts here because if the country's wealthiest people start managing their wealth abroad after earning it here, the question arises, is India's tax system and investment environment pushing capital away? And curiosity is born right here. Why do the ultra-rich actually do this? Is this a story of leaving the country or a calculated strategy of tax regulation and global diversification? This debate intensified when 𝐼𝐨𝐥𝐥𝐨𝐰, founder of 𝐻 and a finfluencer, wrote on social media that in the coming times, rich people will work in India but will invest and retire abroad. The core idea of his point was that earning operational income in India might be wise because businesses benefit from India's growth. But for investment income, dividend income, and retirement planning, many wealthy families are setting up family offices abroad. Business Today and Economic Times also raised this issue based on his viral post. Is India's tax structure influencing the wealth strategy of the rich? Now first understand what a family office is. Very wealthy families create a professional setup to manage their wealth. This setup looks after investments, tax planning, succession planning, philanthropy, real estate, global assets, trusts, and the financial planning for the next generation. A normal family thinks as far as bank FDs, mutual funds, and property. But an ultra-rich family may have listed shares, private equity, startup investments, global funds, bonds, real estate, art, trusts, and operating businesses. To manage such vast wealth, a structured office is needed, which is called a family office. The most interesting angle in 𝐼𝐨𝐥𝐿 point is that the rich look at income in three parts. First, operational income, that is, income coming from the business. Second, investment income, the returns from shares, bonds, dividends, rent, and portfolios. Third, lifestyle and retirement planning, meaning where to live in the future, in which country to keep assets, where the children's education will happen, and how wealth will pass to the next generation. The ultra-rich look at these three through different lenses. An ordinary person often earns, saves, and retires in the same country. But rich people make borders a part of their financial planning. Doing business in India is attractive because India is a growth market. The population is large, consumption is increasing, infrastructure is being built, digital payments have grown rapidly, the middle class is expanding, and demand in many sectors looks long-term. Businesses like ports, mines, telecom, consumer goods, finance, real estate, manufacturing, and digital services can directly benefit from India's domestic growth. If an entrepreneur builds a strong business in India, their operating wealth can be created from here. The tax angle also comes in here. In India, there are different corporate tax regimes for domestic companies. According to the Income Tax Department, options like a 22% concessional rate for certain domestic companies and a 15% rate for new manufacturing companies are available with conditions. The government also announced a slash in corporate tax rates for domestic companies in 2019 to boost investment and make in India. This means the tax treatment of business income and personal income can be different. But the story changes for investment income. When money moves out of the business and into a personal portfolio or family wealth, the tax rules change. Long-term capital gains tax rules on listed equity, slab-based taxation on debt instruments, slab rate taxation on dividends, real estate gains, surcharge, cess, and compliance requirements, all these make planning complex for the ultra-rich. Akshat's point was exactly this. Earning money from business in India makes sense, but looking at the tax and compliance on investment income, wealthy families start looking toward global structures. Dividend income is a simple example of this. Earlier, the dividend distribution tax system in India was different, but now dividends are generally taxable at the applicable slab rate in the hands of the investor. Information from the Income Tax Department also shows that dividends can be taxable at the applicable tax rate in many cases, and for individual investors, this can go up to the slab rate. This means for high-income individuals, the effective burden on dividend income can be higher. There is also a debate on the taxation of debt instruments. Reuters reported in January 2026 that India's chief economic advisor recommended reducing tax on debt instruments to lower the cost of capital and strengthen long-term capital markets. The report also mentioned that debt instruments could be taxed at individual income tax rates, which can go very high for high-income earners. This discussion shows that investment taxation is not just a complaint of the rich, but also an issue of capital market development. Now the question is, why do wealthy families look toward places like Singapore or Dubai? The first reason is tax efficiency. The second is regulatory stability. The third is global investment access. The fourth is currency diversification. The fifth is succession planning. If a family's wealth is spread across many countries, companies, and asset classes, they aren't satisfied with just an India-based structure. They want a setup in a jurisdiction where global banks, fund managers, legal advisors, and investment products are easily available. Singapore is considered special in this regard. It is a major financial hub in Asia, with a strong ecosystem of family offices, wealth management firms, and global banks. Dubai is also rapidly becoming a center for wealth migration and family office setups, because Dubai offers a tax-friendly environment, lifestyle, connectivity, and business-friendly policies. Rich families choose such hubs not just to save tax but also for global mobility and capital protection. However, it is important to understand that setting up a family office abroad is not illegal in itself. If the wealth is legally earned, taxes are properly paid, foreign remittance rules are followed, RBI and FEMA compliance is correct, and disclosures are transparent, then global diversification can be legitimate financial planning. The problem arises when someone takes wealth out through black money, undisclosed assets, or illegal routing. Therefore, investment abroad and illegal money parking should not be considered the same. Another major element in the strategy of the ultra-rich is residency planning. Many wealthy families think about where to keep their future residence based on children's education, healthcare, lifestyle, passport strength, taxation, and inheritance laws. Some choose Singapore, some the UAE, some the UK, some the USA, and some Europe. This decision is not just based on emotion, but is linked to numbers, lifestyle, and the legal framework. This is where a big difference is seen between the thinking of the middle class and the ultra-rich. The middle class often thinks of things like Section 80C, insurance, PPF, ELSS, home loan interest, and HRA to save tax. The ultra-rich think about tax residency, holding companies, trusts, offshore funds, family offices, succession, treaty benefits, and estate planning. The middle class builds wealth from a salary. The ultra-rich protect wealth through structure. The debate over Akshat Srivastava's point also happened because it contains an uncomfortable truth. Consumption and business opportunities in India are massive, but high-income taxpayers feel the pressure of tax, surcharge, and compliance. If a person feels that tax on investment returns is high, rules change frequently, and there are better options for global diversification, they might think of allocating a portion of their wealth abroad. The question is, should India try to keep such wealth in the local ecosystem through tax reforms and capital market reforms? This is where nationalism and practicality collide. One side says that people who earn from India should invest in India. The other side says that a wealth owner has the right to invest anywhere in the world in a legal manner. The truth perhaps lies in the middle. The country should create an environment where capital naturally stays here. But the investor also has the right to diversification while staying within the law. If tax and regulation are too complex, capital will seek efficiency. Money is driven by risk return and rules, not emotion. Another angle to this debate is brain and wealth migration. When entrepreneurs build businesses in India but shift their families and wealth abroad, the country can experience both types of gains and losses. The gain is that the business creates jobs, tax, and growth in India. The loss is that long-term wealth management fees, investment flows, and the economic participation of the next generation might go abroad. If the next generation becomes emotionally and financially disconnected from India, the country could face a silent loss. But it is also true that global wealth management doesn't mean an exit from India. Many families continue to invest in India even after setting up a foreign family office. They participate in the India growth story through private equity, public equity, real estate, or operating businesses. The only difference is that the investment structure might be outside India. That is, money isn't entirely fleeing India. Rather, India exposure is being managed through a global structure. Now, what should an ordinary investor learn from this story? First, don't ignore tax. Wealth isn't built just from returns, it's built from post-tax returns. If an investment gives a 12% return but only 7% remains after tax and costs, the real return is 7%. Second, diversification is necessary. Keeping all your wealth in one asset, one currency, one country, or one business can increase risk. Third, don't take compliance lightly. rich people do tax planning. Tax evasion should not be done. Fourth, financial education is very important. There is a message in the way Akshat said that rich people quietly learn these things. Wealthy people understand taxes, structures, incentives, and loopholes. The middle class often just buys products like insurance, mutual funds, FDs, or property. But if you want to build wealth, you have to understand the system before the product. Where will the money be taxed? When will it be taxed? At what rate will it be taxed? What documents will be needed? How will liquidity be? All these questions are essential. Fifth, every strategy is not for every person. Creating a family office is practical for the ultra-rich, but unnecessary for a normal investor. Opening an account abroad, making offshore investments, planning tax residency, these are all complex and regulated matters. A common investor should take guidance from a legal advisor and tax professional. Inspiration can be taken from social media posts, but action should always be taken after considering the law and personal situation. There is also a message for the government here. If India wants wealth to be invested here, tax rules should be predictable, fair and simple. Clarity in areas like capital gains taxation, debt taxation, dividend taxation and inheritance planning is very important. Long-term investors want stability. If rules change repeatedly, investors price in uncertainty. And the more uncertainty there is, the more capital will seek global safety. India still has an enormous advantage. The growth is here. The consumption is here. The talent is here. Digital infrastructure has grown rapidly here. The startup ecosystem is strong. The manufacturing push is underway. If policy stability and investor-friendly taxation go hand in hand, both global and domestic wealth can find opportunities in India. Therefore, the right conclusion of the debate is not that the rich are wrong or the government is wrong. The right question is, what kind of environment is India creating to attract and retain capital? This strategy of the rich is like a mirror. It shows that high net worth people make decisions based on incentives, not emotions. Where there is a business opportunity, they do business. Where there is tax and investment efficiency, they build a family office. Where they feel lifestyle and future safety, they plan their retirement. This is a practical world where money sees borders but sees rules even more. In the end, the story returns to the same point. A businessman is earning in India because India is giving growth. But he is investing abroad because he sees global diversification, tax efficiency and future security. This strategy might sting many people, but it's important to understand it. Because in the world of wealth, the question isn't where the money was born. The question is where the money will be safe, where it will grow, and how it will reach the next generation.
If this video has taught you something new, or if you feel this information should reach more people, don't forget to like and share the video. Your small share can become valuable and useful information for someone else. If you have any questions related to this topic, or if you would like to share your opinion with us, be sure to write in the comment box. We read every question and suggestion from you, because your feedback inspires us to create better content. And if you want to keep receiving such interesting and reliable information about business, the economy, and the world in the future, then don't forget to subscribe to our channel GRT Business and also press the bell icon so that you get notifications of every new video directly. At GRT Business, we always strive to provide you with accurate, balanced, and reliable information. Our news and analysis are prepared based on information obtained from various news agencies, public sources, and public opinion. We make every effort to verify and validate each fact as much as possible. But in case of any possible error or dispute, the responsibility lies with the respective sources. Our only aim is to present you with a correct and trustworthy perspective so that you can understand any topic better.